Let's talk about initial public offering or IPO. What is it? An initial public offering refers to the process of offering shares of a private corporation to the public in a new stock issuance. Companies must meet requirements by exchanges and the Securities and Exchange Commission, or SEC, to hold an IPO. IPOs provide companies with an opportunity to obtain capital by offering shares through the primary market. Companies hire investment banks to market gauge demand, set the IPO price and date, and more. An IPO can be seen as an exit strategy for the company's founders and early investors, realizing the full profit from their private investment. Let's take a look at the IPO process. First, valuation and preparing the company takes place. After that, due diligence is happening. Due diligence is an investigation, audit, or review performed to confirm facts or details of a matter under consideration. In the financial world, due diligence requires an examination of financial records before entering into a proposed transaction with another party. Preparation of prospectus would be the following step after due diligence. A prospectus is a formal document that is required by and filed with the SEC that provides details about an investment offering to the public. The prospectus can help investors make more informed investment decisions because it contains a host of relevant information about the investment. After the prospectus is ready, the company should apply for listing on exchange, and then the management preparation presentation and pre-marketing to select institutions begins. The next step is performing roadshow and book building. Those steps will be discussed separately in the following videos in details. And then final pricing and listing and support takes place. As you can see, in all of the steps, equity capital market bankers are involved. In addition to that, during due diligence and preparation of prospectus, accountants and lawyers are involved as well. And then when presentation preparation and roadshow takes place, sales team is involved into the process. As for the final pricing and listing and support, the team involves equity capital market bankers, sales team, and traders as well. Let's take a look into pros and cons of an IPO. When we're talking about pros, you can consider that the company can raise additional funds in the future through secondary offerings, which is great. It attracts and retains better management and skilled employees through liquid stock equity participation. And IPOs can give a company a lower cost of capital for both equity and debt. As for cons, there is a significant legal, accounting, and marketing costs arise, many of which are ongoing. Increased time, effort, and attention required of management for reporting. And there is a loss of control and stronger agency problems. So when making a decision to go public, the company has to consider all pros and cons to make a final decision. It is a big decision for the company, and it has to be managed properly.